The yield curve has just steepened by a full percentage point coming out of an inversion. The last time this happened was in 2020 during the COVID-19 recession. Before that, it was towards the end of 2007 heading into the great financial crisis. And before that, it was in 2001 heading into the dot-com bust. Every single time the yield curve has done this, it was either during a recession or right before a recession began. And that includes the Great Depression, where the yield curve steepened by a full percentage point in October of 1929, the very month that marks the beginning of the Great Depression. Yes, Peter, we've heard all of this before. When the yield curve steepens, that's when the recession is meant to begin. So then where on earth is the recession today? GDP growth in the United States is still trending at a healthy 2%. According to government data, the job market is still relatively strong. And in case you don't trust the government data, then just look at the stock market. It's at all-time highs. Not really things you would typically associate with a recession, right? Maybe this incredible indicator, the yield curve that was discovered by Mr. Campbell Harvey in the 1980s, is finally dead. Maybe it's time to say goodbye to the yield curve's flawless track record. Let's try and figure out if we're there yet. First, a very brief rundown on what the yield curve is meant to be and why a steepening is meant to coincide with a recession. The yield curve takes a longer-term bond yields, like the one you get on a 10-year treasury bond, and shorter-term bond yields, like the one you get on a 2-year treasury bond, and it looks at the difference between them. This is what it looks like. This is the yield on a 10-year note minus the one on a 2-year note. Now, most of the time, you have the 10-year yield that is higher than the 2-year yield, so the yield curve is above zero. But sometimes the 10-year yield becomes lower than the 2-year yield, and that's what you call a yield curve inversion. Now, this usually happens because the Federal Reserve has been raising its interest rate. They control shorter-term yield, and so they can deliberately make it so that the yield curve inverts. This is what they call restrictive policy, something you may have heard them say before. Now, for reasons I won't get into in this video, restrictive policy isn't great for the economy. It makes banks in the United States stop lending, and every single time that leads to a recession. And that's where the yield curve steepening comes in. It's when the yield curve is coming out of an inversion. And that happens when the Federal Reserve begins to cut interest rates because the economy is weakening and likely heading into a downturn. So now you're all caught up. Let's come back to our question, why on earth has a recession not yet started today despite the yield curve steepening? Well, when we look at where the yield curve is at the very beginning of the last 4 recessions, it's kind of a little bit different every time. For example, in 1989 and 2020, the recession started when the yield curve was at 0.1%. In 2001, the recession started when the yield curve was at 0.5%. And in 2007, the recession only began when the yield curve was at 1%. So this right here is the hot zone where recessions typically begin. Today, the yield curve is in the hot zone for sure, but we can't completely invalidate the yield curve as a recession indicator. Because if you had set that in July of 2007, when the yield curve was at exactly the same spot as it is today, you would have been painfully wrong, because the recession didn't begin until the yield curve had steepened all the way up to 1%. If we assume that the same thing is going to happen again this time around, the yield curve could continue to steepen until January of 2025 before the recession actually starts. Now, if the yield curve steepens past this level over the next year and we still haven't entered a recession, that's when we can say that the yield curve's validity as a recession indicator really comes into question. But this is a very mechanical way of looking at the yield curve. We're merely just observing the levels and comparing the different episodes we have throughout history. There is another way that we can assess whether or not the yield curve is going to be correct this time around, and that is by looking at the US job market, or more specifically, initial jobless claims, so the number of people that are filing for unemployment every week. If this chart looks familiar, that's because it is. It's almost the exact reflection of the yield curve itself, and that's been the case going back all the way to the 1960s. 90% of the time, the yield curve is following the exact same path as initial jobless claims. Why does this happen? You can go ask the Fed. We're just looking at the end result here. Now, you may have noticed that initial jobless claims recently have been particularly strong despite the fact that the yield curve is steepening, so they haven't really been going in the same direction. Now, this is unusual behavior because most of the time when a steepening occurs heading into a recession, you tend to see initial jobless claims moving higher and confirming what is happening in the yield curve. Now, we have 2 potential scenarios here. Scenario A, initial jobless claims never end up moving higher, and the yield curve actually ends up reinverting, which would delay the timeline of the recession. This happened briefly in 1999 when the yield curve steepened, but initial jobless claims continued to trend lower. It also happened very briefly in 2006. The yield curve steepened, but the job market remained strong, and so the yield curve reinverted. In both of these cases, the recession didn't play out immediately, but a couple of years later. Now, in scenario B, initial jobless claims actually begin to move higher over the next few months and catch up to the yield curve. Now, that's actually exactly what happened in 2007. The yield curve was steepening even though the job market was still quite strong. The steepening continued, and eventually initial jobless claims began to trend higher, marking the beginning of the recession. So which one is it going to be, scenario A or scenario B? Well, there are many experts out there that argue that the economy is nowhere near a recession because of the extreme levels of government spending. Indeed, when we look at US government spending, it has been very elevated recently, certainly some of the most aggressive spending that we've seen over the last decade. But if we zoom out a little bit, we see that the US government was also spending a lot heading into the 2008 recession. Perhaps less than today, but still, it didn't do much to stop the worst economic downturn since the Great Depression from occurring. So that puts a dent in the idea that government spending alone can stop a recession from occurring. At Bravos Research, we believe that we're in the process of seeing scenario B playing out, meaning that we expect initial jobless claims to begin trending higher, catching up to the signal from the yield curve, and for this to coincide with the beginning of the next recession. And if we're following a similar path to what happened in 2007, that could be about 3 months from now. Now, what does that all mean for the US stock market that's breaking out to all-time highs? You do tend to see the stock market fall heading in the months before recessions occur. That happened in 2000, in the couple of months before the 2007 recession, and going back further in history, we also saw the stock market peak well in advance of the 1974 and 1980 recessions. This is why most investors that believe we're very close to a recession are turning bearish right now. After all, with only a few months left before the recession starts, stocks should be declining, right? Well, history also shows that the stock market can sometimes continue to rise until the very last moment. That happened in July of 1990, in February of 1980, and it also happened in September of 1929. This is why we're staying extremely flexible with our equity strategy today. Not just because we want to pick up nickels in front of the steamroller, but because we're also aware we could be wrong about a recession occurring in the next few months.